Welcome, everybody, to Stock Market Investing with the ARMR Report. Thanks for joining the morning meeting, ARMR Insiders. Let's dive right in and talk about most important thing, risk monitor yellow. Okay, so as always with these morning calls, we're trying to get ourselves ready for the trading session and see where we are in the cycle. So what I'm sharing with you is the ARMR Investing way, right? It's a process of managing capital. I've been doing it, and I guess kind of creating this strategy over 30 years, right? It's been evolving, and I'm sure it'll keep evolving. The very core of what we're doing here is to get ourselves on the right side of probabilities over and over again when reward is worth risk. So what I've done is I've created the risk monitor for you, right? So you can see that right here, okay? Click on your risk monitor, you go in and you see, and this really doesn't change too often. There's only 3 colors, right? Right now we're on yellow light, okay? And I share with you what I'm thinking here. Current risk posture, yellow, okay? So what this means is, this is 3 stages of investing. Risk monitor red, obviously, raise cash, be very defensive, look for markets to go down. Risk monitor green is a 5-day window of putting capital to work. Why is it for 5 days? The very essence of what we're trying to do is put our capital to risk when reward is at its highest and risk is at its smallest. How do we define risk being at its smallest? It's about stop losses. There is a preeminent, there is a chief stop on every position. You can change the stop, you can raise the stop, but there's only one real stop on every entry point. That is the optimal stop. Let me show you what I mean. Okay, let's just take Teledyne, for instance. You can see, and we didn't sell the stock. Now, the 50-day moving average could have been the stop, okay, but we didn't sell it because we looked at Teledyne and we said, look at this pattern, okay? Clearly, $400 a share is the preeminent, optimal, chief, and whatever other synonym you want to use, stop on this investment. As long as it stays above that level, we stay with the stock. There are many different stops you can come up with, and this is where people get lost in the weeds on stops, and it ends up not working for them, and they get frustrated. You can't choose the stop you want. You can't say, well, I'll let it go down 2% and I'll get out of it. That's not really a stop. That's just you randomly coming up with how much money you're willing to lose, okay? Every position, and this is key, and this is where I differ from William O'Neill and the way he teaches. He likes to say 7% is the stop on all positions. That has never made any sense to me, right? Because some stocks have a lot of beta and they could move 7% in 10 minutes. And other stocks could take, 10 days to move 7%. So how is 7% the right stop on every type of stock? It can't be, right? The stop on, I'm sure you understand, I'm beating a dead horse, but the stop on DNN, okay, on Denison, $1.20, right? $1.20 price is going to be different than the stop on IBM. That's just common sense, right? So there is one preeminent stop in every position, and that's what we want to try and get as close to that. So now we're looking at the S&P, okay? From the S&P standpoint, the 50-day moving average and the uptrend is the stop. You can sell it faster. It goes below the 25-day move. You could do that. But the real stop is right here, this double bottom. As long as we stay above the double bottom, we're going to stay risk monitor yellow. We're not going to turn red. It's going to have to take out those lows along with confluence and other indexes, and we'll go risk monitor red. So 5 days after the call of risk monitor green, we are generally further away from that stop. So our risk is increased. And so I go risk monitor yellow to remind all of us risk is increasing because the distance to the stop is getting bigger, which is bullish, right? That's what you want. You want the distance to the stop to get bigger because then you're getting closer to targets and we start booking profits. And that's why I say we've entered the realm of managing success. Power of positive thinking. We want to see stocks go higher. When they hit targets, we book profits, we raise stops. That's when you start raising stops. You hit targets, you raise stops, so you can wall off your risk to your principal, and you're only playing with the house's money. That is the ARMR investing way. Okay? The other component is time. So we want to see the price take off. If the price doesn't take off, we move away from the stop and it starts to go sideways and roll over in time. We're getting further and further away from that trigger event that got us to get long. That momentum is starting to die, and we're going to need a secondary, tertiary event trigger to get us to new highs. And if that doesn't happen, sometimes you roll over, you break down, and the risk entry you had and you were able to make a little bit of money comes right back to where you were. You have to start all over again. Raise your cash, stop out positions, wait for the next opportunity. This is a grind, guys. This is a marathon. Last year was a sprint that's I've almost, quite frankly, last year was the greatest year of my professional career. I've never seen a year like that. We got out of the market right before it dropped 40%, and we got into the market at the bottom. I mean, come on. That just doesn't happen. That's the kind of thing you wake up in a dream and you're like, oh my God, Dad, check this out. We top ticked the market on the way out and we bought it all back at the bottom. It was the greatest dream of my life, right? So now we're back into reality. And reality can be a lot of starts and stops as you're defending capital until you get the next window where the market rips. And let me tell you something, it'll come at a time when you don't expect it. There'll be guys all over YouTube telling you the market's going to crash. And that's precisely the time the market will step up 5 or 10%. And if you put the right positions on, you're going to be up 10 or 20%. And that's how you make your year. Now, here's a pretty picture. And this is where it gets a little more bullish for me. And this is what I say about confluence. While the S&P is struggling a bit, you're getting small caps that are breaking out of a great base. If that keeps happening, my guess is this will resolve higher. Typically, small caps are the canary in the coal mine, and they get weak first, and they really break down when things are about to get ugly. And this gets me to my point where I'm shifting. So what do we do? Risk monitor yellow now. The last day of risk monitor green and really for the next couple of days in my aggressive portfolios, I'm shifting capital away from bigger, lower risk type of investments. And I'm using that capital for higher risk, higher reward, smaller cap investments. And I'm really intrigued by the BioTech space. Let's go take a look real quick. Okay. I've been watching these names for a long time. I might be adding some shares of Beam to the portfolio. So we have this huge rip here, beautiful weakness in the midst of an uptrend. And now we're trying to get back above the 50-day. I don't like this bar right here, but I'm watching this closely. That could be an addition. I'm also a big fan of BNGO. Been a big fan for a while. Bio, nano, genomics, right? I love the genomics story. We own Illumina. We own Pacific Biosciences. This chart looks really intriguing to me. Illumina we already have in the portfolio, and that's working well. We bought it right off the low, right? And Pacific Biosciences is a little more tricky, but still staying above the low. I don't love that pattern. It might hit a stop, and I'll have to take it out, but I'm going to give that a shot. It's all part of the package for me. And then we added some real risk yesterday here. Immunity Bio, okay? We made a lot of money on this stock on the way up. I didn't make nearly as much as I should. I think you guys made a little more than I did. But that was a huge rip, right? This company has a product that is a potential cure for pancreatic cancer, of which there are no cures, right? And it's a fascinating technology led by the CEO of the company, the brainchild of this guy of the company is the doctor who created Abraxane, which was the first real cure for breast cancer. So the guy knows what he's doing. It's a compelling story. The stock ripped higher and then imploded. They made an acquisition up here. There's also some noise coming through based on vaccines for the Wuhan virus. Companies that were secondary companies coming up with vaccines probably have a much longer road to getting a vaccine. And I think the market didn't really like that. And so it just bottomed it out at 200-day. To me, this is, again, a pure story about cancer research and cures. And we have the one of the largest, if not the largest, cancer convention today. I think for the rest of the week. It's called ASCO, I published it in the Slack room the other day for you guys to see it, what's there. And very often companies make some interesting abstract announcements. They say, hey, look at, we're doing this study and it seems like there's some positive results. It can juice the stock. I don't know if that's going to happen, but that's the right risk reward entry point. Okay. If it goes below the low of right here, I have to get out of this trade. As we shift to risk monitor yellow, I posted for you in the portfolio update page of Slack, the names that are close to the stops that are on the spreadsheet. I'm watching them closely. If they're below those stops after 11:30 today, selling positions, raising cash, may not put the cash to work. Conservative accounts at this stage don't put cash to work. If you get stopped out, you begin building a cash position. Your upside will be a little bit limited and you'll be protecting capital. So I do that with my conservative accounts. My aggressive accounts reinvest the assets up until the point where we get risk on